that previous example had a distribution. It was on the K1, and I kind of described it as like, you know, a withdrawal from your bank account. You know, as long as you have basis, as long as you have a balance in there. Distributions, usually there's no gain or loss on what they call a non-liquidating distribution. Non-liquidating just means that you still own the same amount that you did before, right? It's not, you're not being paid back or you're not giving up any part of your ownership. If you were a 25% owner before, you're still a 25% owner. You're just withdrawing from your account. And usually there's no gain or loss as long as, like I said, there is basis. So for example, we've got Davis, 50% partner. Basis is $85,000 in his partnership. He receives a cash distribution of $84,000. He recognizes no gain or loss on the distribution, but he's going to reduce his basis to $1,000. All right. He is going to have to pay tax on whatever the income was this year, which the good thing about partnerships is usually those distributions aren't taxable. The bad thing is there are years when you have to pay tax on income you didn't receive, right? But it's increasing your basis. So you've got ordinary income of $50,000, but you didn't get a distribution. Well, you've got to pay tax on that $50,000 even though you didn't get any cash out of it, right? So you're gonna have to come up with that $50,000. The two exceptions, and we've already kind of talked about one of them. When money or securities are distributed in excess of the partner's basis, a gain is recognized to the extent of the excess. Or the current distribution triggers a pre-contribution gain. So if money or marketable securities, cash-like assets, exceed the basis, the partner will recognize the excess as a capital gain. If it's property, it's a little bit different, okay? So in this case, he received a cash distribution of $86,000, but his basis was $85,000. That means he's got, and I called it dividends. It's still gonna be at the dividend rate, that's right. So he's gonna recognize a $1,000 capital gain on that distribution after the distribution, and he was gonna have a zero basis at the end. But that $1,000 brings him back up to a zero basis. So a pre-contribution gain is when a partner contributes appreciated property to a partnership. So this is property that has gone up in value, but they haven't recognized a gain on it. So if I have a building that I bought for $100,000 and now it's worth $200,000, that's appreciated property and I'm donating it to the partnership. If within 7 years the partnership distributes the same property to another partner, so now they're giving that property to a different partner as a distribution. In essence, the contributing partner is selling the property to the distributing partner and attempting to eliminate the gain by passing it through the partnership. They're trying to do a workaround here. So if the contributed property is distributed to another partner within that 7 years, the contributing partner will recognize the gain. So here's an example of that. We've got Bailey contributes land to a partnership. Basis is $8,000, fair market value $12,000. It's appreciated, it's gone up in value. In 2023, the fair market value of the land is now $14,000. And the partnership distributes the land to Jessica, who is another partner. The distribution will then trigger a pre-contribution gain of $4,000 to Bailey, who originally contributed it. Jessica has no gain or loss on the distribution, has a basis of $12,000. So what's going to happen is, so she transferred it to the partnership, and then the partnership transferred it to somebody else. And they did this in order to avoid any, essentially they're trying to work around Jessica directly buying it from Bailey. If that happened, then Bailey would have a gain. Jessica has no gain or loss on the distribution, has a basis of $12,000, which is the $8,000 carryover basis. So $8,000 basis went from Bailey to the partnership, and then from the partnership to Jessica, plus the $4,000 gain that Bailey is recognizing. obscure, but I'm kind of surprised they mentioned it in the book, but oh well. So distributed property instead, not cash or marketable securities, but property. So when property is distributed to a partner, neither the partner nor the partnership will recognize a gain. The basis in the holding period carries over to the partner. So just like it carried over from the partner to the partnership, it carries over from the partnership to the partner. It just continues on. So the partner is going to step into the shoes of the partnership. There is an exception to that when the basis in the distributed property exceeds the basis in the partnership interest. So I have a $50,000 basis in my partnership. I receive a building that has a basis of $100,000 as a distribution. So now I'm receiving something with a basis more than what my basis is. If that was cash, I'd have to pay tax on the extra $50,000, right? It'd be a capital gain because it's $50,000 more than what I originally, what my basis was. What happens though is you don't have to pay extra. You don't have to pay tax on that. You don't have to pay capital gain. The difference in the basis then attaches to the building that you are receiving. So, for example, basis of the distributed property is limited to the basis of the partnership interest. So, partner recognizes a gain only if the distribution exceeds basis. Distribution consists only of money and marketable securities, but if it's property, it's different. Let's look at these examples here before I see if I need to make up a different one. So we got Fonda, partnership basis is $6,000. She receives from the partnership a distribution of equipment. The equipment has a basis of $8,000. That $8,000 is more than her basis in the partnership, right? Has a fair market value of $5,000. The basis in the equipment to Fonda after the distribution is going to be limited to her basis in the partnership of $6,000. She recognizes no gain or loss, but now she has a zero basis in the partnership interest after the distribution. So originally, so her basis, $6,000. She's getting a piece of equipment though that's worth $8,000. $2,000 more than what her basis is. The fair market value of it is $5,000. We really don't care about that until she actually sells it though. What she's gonna get is the basis in the equipment to her is not going to be the carryover basis of, is not going to be the carryover basis of $8,000. Ordinarily, if she had basis, it would be the carryover basis of $8,000, but she doesn't have basis in the partnership. So the basis, the difference is going to adjust the basis of the property. So that when she sells that, she's going to pay more of a gain than she would have. So her basis now is going to be limited to what her basis in the partnership is. I'm getting a lot of blank stares.
So the other $2,000 that she doesn't get is added to the $8,000?
It's subtracted from the $8,000. So if she had a basis, let me see. Let's say that her basis in the partnership was $8,000, and she received property with a basis of $8,000. Now, that will reduce her basis in the partnership to zero. But the property that she receives, remember, this is going to carry over. So her basis to the partner would equal $8,000. So when she sells this, say she sells it for $10,000, she's going to have a gain of $2,000 when she sells it. So this is going to have a carryover basis. Remember, when you contribute property to a partnership, it's a carryover basis, carryover holding period. When they distribute property, it's carryover as well. You just get their basis, the partnership's basis. unless your basis isn't enough to cover that. In which case, what happens is 6,000, we still have to make this zero. We can't go below zero. So what's gonna happen is that 2,000, now she's got a 2,000, basis to the partner is gonna be the 6,000 basis of the partnership minus, the $8,000 of the property. You're gonna have to think of this kind of in a negative, I mean, I know it's gonna be a negative number, but it's really a positive. So now she's got a basis to the partner of the property of $2,000, the basis in the partnership is 0.
And to partner is the inside basis, or is that?
This is the outside basis. This is to her. This is her basis.
But the
So,
other one is,
her basis, right, so her basis in the property, there are two different bases here, you're right. Her basis in the property now is $6,000. The property that she received. Remember before, if she sold it for $10,000, she'd have a $2,000 gain. Now if she sells it for $10,000, she's gonna have a $4,000 gain. Okay? But then we're talking as well about her outside basis in the partnership, which is gonna be 0. Other questions? Let's look at these examples and see if they do a better job than I do. They very well might. Same facts, except she receives a $2,000 distribution and the equipment. So in this case, she's gonna first reduce her partnership basis by the $2,000 cash distribution. So this, her basis in the partnership, 6,000. And then we're gonna subtract the cash of 2,000. So now her adjusted basis in the partnership is 4,000. She does not recognize any gain, but now she's got a basis of $4,000 in the, because this is gonna be 2, 6, yeah. What do I want? Property, so the basis to the partner, so she's still limited to 6,000, but she got that cash distribution of 2,000. So now the property is gonna be $4,000 basis. So cause what she's getting, think of it this way. She's got a basis in the partnership of $6,000, but she's getting an $8,000 piece of equipment and a $2,000 cash distribution. There's $4,000 there that's not accounted for. That's the adjustment that she has to make to the basis of that carryover basis. So you'd want to figure out what is the carryover basis, it's whatever it was to the partner, and then subtract the amount that's over and above her basis that she's receiving. Does that make sense? So she is receiving, let me do this. This is what she's receiving. Okay, so basis in the partnership is 6,000. What she's getting out of the partnership, she's receiving $8,000 property and $2,000 of cash, right? this, if we were to subtract that, what she received, we'd be in negative territory. So, 6,000 minus 10,000, that is going to attach to the property, okay? So now we're gonna take the $8,000 property minus, what is this fly? This is the basis, now the basis in the property. When she goes and sells that property, she sells it for $10,000, now she's got a $6,000 gain. Okay, so I guess take the basis in the partnership, subtract what she's receiving, the difference, and then subtract the difference between that and the basis, subtract that from the basis of the property she's receiving. I have another example here. Maybe we could use one of these, let's see. How about this one? Let's look at Nelson. Okay, so partnership basis is 12,000. He receives from the partnership a distribution of furniture with a basis to the partnership of 16,000. Fair market value is 10,000. All right, so this can't, remember if we were to subtract this, we can't go below 0. So this is again $4,000 difference. We're gonna attach this basis would ordinarily transfer over to him. We're gonna adjust that basis by the 4,000. I think it should be B. Does anybody wanna look at the answers are in the back? I don't have the back. I guess I could look. This was $12,000. So the other one. So this one is in the same facts. However, Nelson receives a cash distribution of